I need you to stop what you're doing for a moment and think about a question that doesn't get asked enough in this market. When a billion-dollar buyer decides to accumulate a position, what is the one thing they are most afraid of? Not the price, not the volatility, not the news cycle. The one thing a serious institutional buyer fears is being late. Because when you are managing capital at scale, missing an entry by even a week means paying a price that wipes out a significant portion of your return before the trade even starts. Now, open the Coinbase order book from 48 hours ago. Look at what the data actually shows. Because what showed up in that order flow is not a coincidence, it is not noise, and it is not random. It is a timestamp. And today, we are going to decode exactly what that timestamp is counting down to. Welcome back to Ledger.Wealth.Network. I am the infrastructure analyst. We do not trade rumors here. We do not react to headlines. We read the data that most people scroll right past, and we ask the one question that separates informed investors from the crowd. Why now? This is not financial advice. This is order flow forensics. Let's get into it. Let me show you exactly what the data revealed, because the structure of this order flow tells you more than the volume does. 156 identical buy orders, each one exactly 10,000 XRP, each one executing every 18.5 seconds like a mechanical clock for 48 straight minutes across Coinbase, Bitstamp, and Kraken. Total accumulation on Coinbase alone, $23.4 million. Kraken confirmed over 35 million XRP moved off open markets in under an hour. Now here is the first thing any serious analyst looks at when they see a pattern like this. What does the execution method tell us about the buyer's urgency? When a large institution wants to accumulate a position quietly, they use time-weighted average price strategies, small buys spread across days, sometimes weeks, across dozens of venues. The goal is to leave no visible pattern, no signature. They have time, and they use it. That is not what happened here. 156 identical orders at a fixed interval is an algorithmic acquisition script with a hard deadline built in. This buyer was not hiding. They were racing. They made a calculated decision that the cost of being detected was lower than the cost of being late. And they executed through Coinbase, Bitstamp, and Kraken, not anonymous DX contracts, not over-the-counter dark pools, but the three most regulated, most compliance-cleared, most institutionally trusted exchanges in the Western market. That execution signature carries one message. This is not speculative retail money. This is structured institutional capital moving on a timeline that the public calendar does not yet show. So the question every XRP holder should be sitting with right now is not why isn't the price moving faster? The question is, what does that buyer know that the retail chart does not reflect? Here is the hard truth. The retail crowd right now is looking at XRP's price action and calling it stagnation. Some have already sold. Some are considering it. And while they are posting about broken price action and dead theses, that algorithmic buyer was stacking 10,000 XRP every 18.5 seconds without flinching. The exit liquidity of the frustrated is funding the entry of the informed. And that dynamic has a specific expiration date. Let's put hard numbers on the table, because signals without math are just storytelling. Start with the regulatory layer. On March 17th, the SEC and CFTC issued a joint binding ruling classifying XRP as a digital commodity. 68 pages. Not a press release. Not a tweet. A binding legal document that puts XRP in the same regulatory category as Bitcoin and Ethereum and strips away the primary compliance objection that institutional allocators have cited for years. 7-spot XRP ETFs are now live. Cumulative inflows, $1.44 billion. Standard Chartered's institutional research desk, not a crypto blog, one of the world's largest banking groups, projects $4 to $8 billion in total ETF inflows contingent on the Digital Asset Market Clarity Act passing. That is a single piece of legislation separating current inflow levels from a number that is 3 to 5 times larger. Now layer the tokenization pipeline on top. Nasdaq has publicly targeted Q3 2026 for tokenized stock rollout. The SEC has already approved the rule change enabling it. The New York Stock Exchange is partnering with Securitize for 24/7 tokenized equity trading. The DTCC, the entity that clears and settles virtually every stock trade in the United States, has a 3-year tokenization pilot actively running. And Securitize, the firm at the center of both the NYSE and NASDAQ tokenization initiatives, is already using Rust on the XRP ledger as the settlement layer for BlackRock's BUIDL and VanEck's BUIL tokenized funds. The total addressable market for tokenization starts at $10 trillion in near-term projections. Scale it to include global equities, fixed income, real estate, commodities, and derivatives, and the number reaches into the quadrillions. The XRP ledger is not being considered as a settlement layer for this migration. It is already serving as one. Now run the supply math. XRP has a fixed supply of 100 billion tokens. Approximately 57 billion are in circulation. Exchange reserves have been declining for months as institutional custodians move holdings into cold storage and ETF vaults. Every XRP that moves into a multi-signature institutional wallet does not come back to the open market for a 10% gain. It disappears from liquid supply on a timeline measured in years, not weeks. When institutional settlement demand, entities that need XRP not as a speculative asset, but as actual working liquidity for trillion-dollar transaction flows, collides with a float that has been systematically shrinking, the price adjustment does not happen gradually. It happens in a window. And 35 million XRP were absorbed in under an hour by someone who clearly believes that window is close. Let's stack the confirmation data, because every serious thesis needs more than one signal. Ripple Prime, the institutional brokerage born from Ripple's $1.25 billion acquisition of Hidden Road, has already seen its revenue run rate triple since the deal closed. Brad Garlinghouse confirmed this number himself. What that figure tells you is not just revenue growth. It tells you that institutions which refuse to work with Hidden Road as a standalone broker are now comfortable working with Ripple as a counterparty, because Ripple's balance sheet changes the risk calculus entirely. Every new institutional client through Ripple Prime is a new sustained source of XRP demand, and those clients are not buying in $1,000 increments. Hunter Horsley, CEO of Bitwise Asset Management, stated on record at Blockworks that a significant new wave of institutional crypto adoption is arriving within the next 6 months. His framing was direct. The waiting phase is over. Bitwise manages over $10 billion in crypto assets. Their CEO does not make public statements like that without supporting data from the firm's institutional pipeline. Ripple has deployed over $1 billion in external ecosystem investments over the last 12 months. Capital positioned across the infrastructure before the institutional migration begins in earnest. That is not the behavior of a company hedging its bets. That is the behavior of a company that knows exactly what the next 18 months look like and is building the infrastructure before the demand arrives publicly. Add the Digital Asset Parity Act, proposed by White House Representatives Miller and Horsey, which would allow regulated stablecoins to be used for everyday transactions without triggering a tax event. The qualification criteria, pegged to the US dollar, issued by a regulated payment institution, maintaining parity for 95% of trading days. Rust meets every single criterion. The US government is not just classifying XRP as a commodity. They are building a tax policy framework around infrastructure that Ripple has already deployed. 3 separate institutional signals, 3 separate sources, all converging on the same 6-month window. And 156 algorithmic by orders executing every 18.5 seconds tells you that at least one entity with serious capital and a compliance department behind them has already read everything on that list and made their decision. Here is where the timeline becomes critical, because the assumption most retail investors are carrying is dangerously wrong. The common belief is this: even if the Clarity Act passes, it takes 12 to 18 months before banks actually integrate XRP. Compliance reviews drag on. Onboarding is slow. Legal teams move at legal speed. By the time it matters, everyone will have had time to position. That assumption is not supported by the documented evidence. A Ripple integration executive confirmed the actual onboarding timeline in formal testimony. Credit review, technical integration, testing, and full system connection runs 2 to 3 months for a standard implementation. The fastest documented case was 3 weeks. Think carefully about what 3 weeks means in a live market. Institution A gets Clarity Act clearance. Institution A goes live in 3 weeks. The moment Institution A begins settling cross-border payments on the XRP ledger, Every bank in their correspondent network has a direct financial incentive to evaluate the same infrastructure, not because someone told them to, but because their counterparty is now settling faster, cheaper, and with full audit trail, and they are being competitively disadvantaged by comparison. Network effects do not build gradually. They fire in clusters. And the price does not wait for the news article announcing the first implementation. The price moves when the first live transaction settles and the second institution picks up the phone. The Clarity Act is expected to be marked up in the Senate Banking Committee in April. Senator Marino has publicly warned that if it does not pass by May, it may not move again in 2026. The urgency in Washington is real. The timeline is tight, and the implementation clock starts the moment the bill is signed. Here is the structural reality of the supply side, and I want you to hold this number clearly in your mind. On the day the Clarity Act passes, the day regulatory risk premium gets priced out of XRP simultaneously across every institutional allocation desk in the country. The liquid supply of XRP available on open exchanges is not 100 billion tokens. It is not even 57 billion. It is whatever fraction of that circulating supply has not already been locked in ETF custodial vaults, moved into institutional cold storage, or absorbed by algorithmic buyers running 18.5-second acquisition scripts. That number is shrinking every week, not because of a supply schedule, because of deliberate, structured accumulation by entities that do not sell for short-term gains. 40 billion XRP sits in institutional wallets from Ripple's private sales and has never touched the open market. 7 ETFs are adding to the lockup in custodial vaults daily. And the retail float, the supply that actually shows up when demand arrives, is a fraction of what most people assume when they look at the total supply figure. When the demand event arrives and institutions are not buying XRP for their portfolio, they are buying it because they need it as operational liquidity for live financial settlement. That demand is not price sensitive in the way retail demand is. It is volume sensitive, and the volume available to meet it is quietly disappearing. I want to speak directly to anyone in this community who is sitting in frustration right now. The Clarity Act stalled. Again, Congress went on recess. Again, the price has been grinding sideways while every other asset in the market seemed to find momentum. And watching that while holding a conviction position is genuinely difficult. But here is the reframe that the order flow data forces you to consider. Every week Washington delays is another week that XRP trades below the price it will trade at after Clarity passes. Every frustrated retail seller who exits right now is handing their position to the buyer who ran an algorithmic acquisition script at 18.5-second intervals. The delay is painful, but for anyone who has done the analysis and understands the thesis, the delay is not a punishment. It is free accumulation time at prices that will look like a historical anomaly inside of 18 months. Being early feels exactly like being wrong, right up until the moment reality catches up. The order flow from 48 hours ago is telling you that for at least one very serious buyer, reality just arrived. The question is not whether the thesis is intact. The question is who will still be holding when it becomes visible to everyone else. Let me bring all of this to a single point, because everything we cover today connects here. 156 buy orders, 18.5-second intervals, 3 regulated exchanges, $23.4 million on Coinbase alone, 35 million XRP absorbed in under an hour. That is not a retail trade. That is not a market maker hedge. That is a structured institutional acquisition executed by someone who looked at the Clarity Act timeline, the tokenization pipeline, the 3-week implementation clock, and the shrinking exchange float, and decided that $1.42 was not a price to analyze. It was a price to accumulate at with urgency. Price is a distraction. Value is the reality. Structure is what matters. Comment order flow below if you made it to the end. I want to know who in this community is actually reading the data. In a market fueled by emotion and noise, we thrive on data and composure. Remember, haste leads to loss, while calm analysis leads to victory.